Okay. Now, here I just want to show you a little bit of sort of stock history. Okay, so before modern times, when you bought a share of stock, you actually got what's called a stock certificate, which is what this picture represents. And that stock certificate demonstrated your ownership. It listed your name, it listed when you bought it, it listed how many shares you owned, the price you paid, what the company was, all those things. And this was your proof of ownership of the firm. Right? Now, these days, of course, you don't get one of those. If you buy stock online, you just get a little marker on your, whatever your account is with Fidelity or Schwab or Robinhood or whatever. You can sometimes request a stock certificate, but usually it's just an electronic one that's kept by your broker and you never see it, right? So I wanted you to actually see one, and this is one that my grandfather had. When he died, we were cleaning out his house, and I got really excited when I found these. He had like 5 or 6 of them. This was part of the retirement plan. He was an electrician. He was a member of the electricians union in El Paso, Texas, where I grew up. And this was their retirement plan. The union bought a big stake in this insurance company based in Dallas, Texas, the ICT insurance company. Um, and you can see that it says, Milton House on, in April of 1956 has 50 shares. It's the owner of the above number of shares in the ICT insurance company. And if you wanted to sell, say, your shares in this, you would have to transact. They would scratch out the name of my grandpa. They would put in a different name, and they would, and then the share ownership would be transferred. Now, of course, I got excited. I was like, oh boy, there's a bunch of money here that we never found. But then it turned out that this was one of the biggest insurance frauds in the country at the time. The guy who was running this company ran off with all the money, disappeared into South America. I don't know if he was ever arrested or found again, but certainly these were basically worthless, except to show you guys an example of what it used to look like. Okay, so again, this isn't common anymore. If you want to buy a share of stock these days, you just go online and you do it, and they record it online, and you don't get one of these physical certificates anymore. Okay, so I want to talk a little bit more about dividends, because of course this is one of the most important rights of the firm, and the dividends have some specific rules and rights themselves, rights granted to the company, and the biggest one is that a dividend is not a liability of the firm. Okay. So this is important because of what the thing that we're going to talk about in the next lecture, which is debt. Right? The sort of equivalent payment to a debt holder, to someone who makes a loan to the company, is the interest payment. And interest is a liability. It is considered a business expense. And so when the firm raises money by taking out a loan, they take on a liability. They are now required to pay back the loan and the interest, or the firm can be taken to court and go bankrupt and go into bankruptcy. Dividends are not that way. So if the firm raises money by selling shares in a firm, they do promise to pay dividends to the firm, but they don't have to pay dividends to the shareholders, right? So the firm promises to pay dividends. They don't promise how much dividends they're going to pay. They don't promise when those dividends are going to come. They just say, eventually you'll get a share of our profit. So lots of firms don't pay dividends. Warren Buffett has famously never paid a dividend. Amazon didn't pay dividends for years, neither did Microsoft. Right? They just kept reinvesting. Instead of paying out profit to the investors, they retained all that profit and retained earnings and reinvested it into the company. And so investors have to recognize that when they're buying shares in that company and decide whether they're okay with that as a use of the company's money. But it's not a liability, so there's no requirement. If you even for companies like Procter & Gamble that have steadily paid an increasing dividend for 60 years, even if they decide tomorrow not to pay their next dividend, shareholders have no recourse other than to vote the old board out to try and replace the management, because they think that obviously that's a pretty bad sign for Procter & Gamble to stop a tradition like that, and it can only mean a bad thing about the firm. Okay, but other than that, shareholders have no recourse, right? So until a dividend has been declared, and this usually only happens a day or two before the dividend is paid, the shareholders cannot force the firm to pay dividends. Okay? Now, that doesn't mean that they might not be expected to, like Procter & Gamble, but in terms of legal liability, there isn't any. Okay. Now, because of that, dividends have also sort of an unfavorable tax treatment. Okay, so one of the things we'll talk about in the next lecture when we're talking about debt is the advantage of raising money using debt is something called the interest tax shield, which is that because interest is treated as a liability, as a business expense, it reduces the amount of taxes that we pay. Okay, so go back and look at the income statement. Notice that interest comes before we calculate taxes. So by treating interest as a business expense, as a liability, we reduce our tax liability. So we reduce the amount of taxes that we pay. Dividends, on the other hand, because they're not a business expense, they're not a liability, they do not come before taxes, they come after taxes, they come out of profit. And so they do not give the firm any tax advantage. In fact, they give the owners of the firm a tax disadvantage because dividends are taxed at two places. First, dividends are taxed by the company at the company level. So the company pays taxes, then it's left with profit. And so then it pays dividends on an after-tax basis. Right? The share of the profit has already been taxed at the corporate level. However, when an individual receives dividends, they also pay what's called the dividend tax rate. And so this is what we call corporate double taxation, right? That the company pays taxes, it then shares the after-tax profit with its owners who pay taxes again on their share of the profit. Okay, so there's a lot of grumbling about this. It's probably never going to change. It's been this way for a long time. The dividend tax rate right now, I think, is 15%. The corporate tax rate is 22%. So total, the profits of a company after they get shared to the owners is about 35, 36%. Right? It used to be higher when the corporate rate was 35%. Then the profits by the time they got to the owners were taxed at almost half. Okay? So it is unfavorable, and it is something that companies think about when they are choosing how to raise money for new projects. New investments, right? They get a tax benefit if they raise that money using debt. They have a tax disadvantage if they raise that money using dividends. But the trade-off, and there's always a trade-off, is that debt incurs a liability and equity does not. Okay, so a firm that doesn't have any debt and has only raised money by selling shares can't be forced into bankruptcy because they don't pay dividends. Now, the last the last thing about types of stock that we want to talk about is something called preferred stock. And preferred stock is a different kind of stock. It is distinguished from what we call common stock, normal stock, by a couple of different rights and rules. Okay, so there's basically two general types of stock. One is called common, one is called preferred. And preferred stock has some specific rules. And of course, with those new rules and new rights come trade-offs. Okay? So the big right that comes with preferred stock is a stated dividend. So preferred shareholders know what their dividend is going to be in advance, and they are promised that they're going to receive it ultimately. So you buy a share of preferred stock with the specific dividend attached. So you're going to buy Procter & Gamble's preferred stock, and they're going to pay a 10% dividend. Right, something like that. You know it in advance. And even though it is still not a liability, so a preferred share dividend can be deferred, it must be paid, and it must be paid cumulatively once dividends start to be paid. Okay? So the firm, if they decide, if they are not making a profit and they're not going to pay a dividend, they can defer a preferred dividend indefinitely, even 10, 50, 100 years, but not forever. And ultimately, if they ever want to pay a dividend again, they have to pay the preferred shareholder all of the past dividends that they have deferred, including interest, before they can pay any other common dividends. So this is the big thing for preferred stock. Now that's a very powerful right, the right to receive the dividends, ultimately receive them, whether the firm can pay them in the moment or not. And because of that right, preferred shareholders give up a right? Finance always has a trade-off, and the right preferred shareholders give up is usually the right to vote. So preferred stock typically does not have voting rights, even though it typically does have a stated dividend that must ultimately be paid out.